Another frequent question I get asked is, what are annuities? What do I need to know about annuities? This is a big one. It's funny because when I talk about annuities, that one word annuity, I can talk about a wealth of information. And then suddenly I drop the word annuity and suddenly everything is forgotten up to that point, and suddenly annuity is the only thing that people remembers. So understand that the word annuity is something of a misnomer. So let's demystify the annuity market. All annuity means, it comes from the Latin word annuus, which means something that happens on an annual basis, even though you can be paid or compensated monthly, right? So the three basic different types of annuities. What are those different types? So on a high level, you have three different types. Those are fixed, variable, and indexed annuities. Now they all sound the same, but they're all very, very different entities. And we'll talk about them one by one. So what is a fixed annuity? A fixed annuity is very similar to a CD in that it's very safe, very boring, drama-free. You're looking roughly at 1 to 3% return at the time of this recording. Again, very drama-free, very simple, 1 to 3%. At that point, you're barely hedging against inflation. So just be aware. People like them because they get that consistency in income. It's very safe, but again, low risk, but you are risking the fact that inflation may go higher than that 3%. Next, you have a variable. And by nature, a variable annuity, variable is just as it sounds, variable. It goes up and down. So a variable annuity means it's basically volatile, right? It can go up, we may have some gains, or it can go down drastically. It's tied to the market. All a variable annuity is just a mutual fund wrapped in an annuity. Meaning, you have tax benefits because it's an annuity, but generally a mutual fund is just like a box. You have to put assets in the box. So with those assets, they can be anything from stocks, bonds, maybe a combination. But whatever the case is, if it's a variable annuity, it's probably tied to the market. Now understand that variable annuities were the default go-to instrument in the 80s and 90s because we had a roaring market back then. Because the market was so strong for so long, getting 12 to 15% consistent returns was not unheard of. But that changed, and in the last 18 years, you may be aware that we've had not one but two market drops. In 2002, we had the tech crash, and in 2008, we had the subprime meltdown, both of which caused people to lose anywhere from 50 to 60% of their holdings in their 401k, for example. So with that in mind, it reminds me, think of this Warren Buffett quote that I may mention in another module. When, this is my favorite Warren Buffett quote. It says, when the tide rolls in, you can see who's swimming naked. Meaning people start to take note of the fees and the lack of performance in their portfolio when the bad times happen. So what people have noticed, and I don't know if you know who Tony Robbins is, he's a self-help guru. He's actually tried to reinvent himself as something of a money manager lately. And he wrote a book called Money Master the Game. A very good book, a great 100-level book for investing. I highly recommend it. In that, he has a whole chapter dedicated to variable annuities, and he calls them fee factories because even though there's all this smoke and mirrors where you think you're making money, the fees suck up a lot of that profit. So you have to be very careful with variable annuities. I know there are major companies out there that are branding themselves where they only sell that product, and I'm sure they make a lot of money doing so by that extra layer of fee they tack on. That's how they build their business, but how does that help you as an investor? Understand that variable annuity, we don't recommend we stay away from that. If you had to call it a bad annuity, I don't think there's anything as a bad instrument per se. It's about when you get in and when you get out, but generally speaking, those tend to have higher fees, so be very careful of those. Finally, you have what's called an indexed annuity. And if you didn't know that everything in our business has 2 or 3 other names. So they're called EAs, IAs, FIAs, equity annuities, fixed index annuities, but basically we'll just call them FIA for short, for convenience. So again, here you have 1 to 3%. Variable it can be up or down, anything. Up 20, down 50, who knows. And then finally you have index annuities. So there's something of a hybrid between the first two. So what do we know about fixed index annuities? They're fixed, meaning you can't lose the money. You have a floor. That floor is 0. So you can't lose the money. Why? Essentially, with this product, you're partnering with an annuity company, essentially an insurance company, and you're insuring your portfolio. It's a partnership. And with that partnership, they're saying, look, in the good times, we're going to share in the profit. In the bad times, we're going to take the financial hit. So the least you can be at is 0, and the most you can be at is a cap, essentially, which can be anywhere depending on the particular instrument you go into. There are, 100, 200 different annuity companies, and each one does something different in some cases. So you have to be very careful reading the fine print, what does what. There are different fixed index annuities for different purposes. So it's important you talk to your financial advisor or insurance representative who knows what they're doing and has a clear grasp of what they're selling. Because in some cases, some people I've talked to didn't even know what they were getting into. No one explained what they were in. They were just reassured by their insurance agent. An insurance agent, just a salesperson. So just be aware that they were reassured by that agent that that was the right thing for them, and when they weren't, no one explained what they were really in. And on more than my share of occasions, I've taken the time to really sit down and go through this stuff with a fine-tooth comb so people understand what they're getting themselves into. Because again, there are pros and cons with any instrument, so you have to understand what you're getting into. So with that in mind, with a fixed index annuity, you have a floor where you can't lose money, and you can potentially have some upside, right? So with that, you have the FIA. If the market goes up, you can go up. If the market goes down, you stay flat. If the market goes up, you go up. If it stays flat, you stay flat. If it goes up, you go up. If it goes down, then you stay flat. Notice how you don't have to go up to the original point to be able to make money here. It looks almost like a step ladder in terms of the profit potential. So understand there are potentially 3 different parts to a fixed indexed annuity. What are those 3 parts? There's the growth side, there's the income side, and there's the basically the bonus. So the bonus is just what it is. If you, like, say you bring 100 grand to the table, you get, say there's a 5% bonus, then you get $5,000 out of that $100,000. I know if I was running cross country and had a 5-yard head start, I probably would have won a lot more matches in my high school career than I did. So knowing you had that head start with your investing career, you're going to be much better off. That's why we like the bonus. So that's pretty self-explanatory. So we talked about the growth side, right? So the growth side is this. You have, again, you're partnering with the insurance company where you have the potential to make money on the upside, and then you can't lose the money. That's why people love fixed index annuities. Now understand, with the growth side, there are something called different strategies. You can do, benchmark to the S&P 500, which is a collection of 500 top Fortune 500 companies. You can benchmark in some cases to the Dow, to the Hang Seng, to the Nikkei, any benchmark out there. But we recommend the S&P 500. Historically, it's performed better than most benchmarks. So for that reason, we would recommend the S&P. Now understand also you can go one of 2 directions. You can do annual point-to-point or monthly point-to-point. If you do annual, they just take, let's say, the year 2019 and the year 2020, and they just calculate, was the market up or down, and then they credit your account accordingly. Monthly, you have the potential, if you do a monthly strategy instead of an annual strategy, you have the potential to make more money, right? So let's say you're at, 1.5 or 1.6% per month. That means, multiply that by 12, and that's the potential you can make. However, the good years may be knocked out by the good months may be knocked out by the bad months. For example, you have January, February, March, April. In January, let's say you're down 10, February you're up 10, it's March you're up 2, and then here you're down 3. Well, for the year you're at -1, right? So with that in mind, you haven't made anything because, again, you can't lose anything past 0, but you're still in the negative because the good months cancel out the bad months. So understand that, again, based on your goals, in this particular scenario, 0 is the new hero. So while all your friends are losing 40% in their portfolio potentially, or whatever, or -1, you have the option. 0 is the new hero. You haven't lost anything. You haven't made anything either. So with that in mind, your strategy is contingent based on your goals, your risk, your risk tolerance, a lot of things you need to discuss with your financial advisor before you make these decisions. And I think that's where some of the misconceptions and the craziness comes into play where people don't know. You need to sit down and actively discuss this. It's not just something you rush into. And again, whether it's a stock, whether it's even a bank account, I mean, even bank accounts have consequences. There's an opportunity cost where you may be making a fraction of a percent on your money here, but you could be making 5 to 10% over here. So with that in mind, everything has consequences, and it's important to talk about the pro and cons on any investment you get into. So finally, you have what's called the income side of things. We talked about the bonus, we talked about the growth, now we have to talk about the income side. For the income side, you have the potential to essentially create your own mini Social Security, where you can lock in consistency, getting a certain return for the rest of your life, no matter what. Let's say 6%, for example. So regardless of what happens in the market, you still get a consistent 6% return for the rest of your life, no questions asked. And it locks in at that rate forever. It's like a 6%. So even if you live 120, and if you run out of money, you still have that consistent return on what you initially put in, right? Now, understand there's a little bit more complexity to that, and I can discuss it with you if you're interested in contacting me and go over this in detail. But for the most part, generally, you need time to grow up to that 6%. You don't get it right off the bat. Generally, you aren't able to, like a light switch. You flip it on, then you start collecting the money, but usually they make you wait at least a year, if not longer, before you're able to collect that money. And usually that's what's called a single deferred premium annuity. So with that in mind, with that income, you get, again, you cannot outlive the income. That's why people like annuities. You cannot outlive the income, right? That's why people like them, is because, again, income is the outcome. Without that income, you're just a homeless person on the street. And that's just like Social Security. That's one way. You're basically making a mini version of Social Security where you're guaranteeing you get consistency in income based on really just the fact that you handed over this money to an insurance company and they guarantee you're going to get that consistency in income. So again, those are the 3 ways at a high level. There are more details, but again, talk to me if you want to go into more in the weeds, so to speak. And again, you have the bonus you get, the growth side, and the income side. 3 ways to make money. Not like a stock where it has to go up in one direction with that particular asset, but 3 ways you can make money on a particular asset. So again, this can be a good vehicle, it can be a bad vehicle for FIAs. We recommend, if you're going to go the way of annuity, and I don't know whether annuity is even right for you, I would have to look at your particular situation to make that assessment. But, you know, in comparing it to the others, I think if you are going to do an annuity, an index annuity is generally the best way to go. So again, if you have questions, feel free to drop me a line. I'd love to discuss this with you. And I hope this has been a benefit. One thing, actually, before I wind things up, I would like to discuss one thing that the question is, how is this possible? Right? It seems too good to be true in some cases. Well, it's not. I'll show you how. It's the same way the companies are working with the power of large numbers. Just like they're able to insure people who are driving. Everyone, insurance companies know that everyone's getting in a car accident at some point in their life, right? So it's the power of large numbers, right? They're hoping that because there's a huge number of people, that people aren't getting in an accident or compensating for those that do. So in this case, because they're working with large numbers, they're able to reemploy the money. The companies don't sit on the money. They, like banks, lend to other financial institutions.